Open your cerebral cortex and shift your lobes into upper beta phase, because you are going to have Bitcoin knowledge transmitted directly into your vestibulocochlear. Your host at Bitcoin Knowledge is Trace Mayer, an early Bitcoin advocate since it cost $0.25, but this is not intended to be investment advice. A doctor of jurisprudence, but this is definitely not legal advice. And an investor in core cryptocurrency infrastructure, including Armory, BitPay, Kraken, and Mitagio, but this is not a recommendation of those services. Here, you get fed via direct mind download with pure and free Bitcoin knowledge.
Welcome back to Bitcoin Knowledge Podcast. We have another weekly update with Kevin Zhou. We're going to talk a little bit about the fundamentals and the technical analysis on the Bitcoin price. So welcome back to the podcast, Kevin.
Glad to be back, Trace.
Yeah, so you had some very interesting notes just about the interest rates on US dollars over at Bitfinex. Maybe you could go into that a little bit.
Yeah, the interest rates for dollars on Finex have usually been higher than Bitcoin, and sometimes even 2 or 3 times higher than Bitcoin. So I was starting to wonder why that's the case, and I was thinking about interest rate parity. Covered interest rate parity, and what that is that technically, if you had dollars to loan out, you can get some interest on it, at some rate. And that should be equivalent to converting those dollars to Bitcoin, getting that Bitcoin interest, and then selling a future or a forward on Bitcoin to sort of lock in the future price when that contract closes. So if you go the first route, or if you go the second route, by interest rate parity, it really should, be the same amount, that you get back in terms of return. So, looking at that, it looks like, based on Bitfinex's current interest rates and based on BitMEX futures, that you're sort of better off going with, the Bitcoin route and loaning out money for Bitcoin. So, what it looks like right now, the spot is about like 231.79, and the future, which expires in about 6 days, is trading at 233.13. So if you took 10 grand there, and you loaned it out at the Bitfinex dollar rate, you'd make about $13 in 6 days. And if you took Bitcoin, you'd probably end up making around $61, $62. So it seems like the Bitcoin path is just a little bit better. And really, it really begs the question why that's the case. Because it's showing that covered interest rate parity isn't holding, and it's possible that maybe when there's restrictions on capital controls in the actual currency markets, this sometimes happens where interest parity breaks down. So maybe there's something there. I haven't really thought too much on it, but it is strange, and it really, in a purely efficient and open market, free market, interest rate parity should hold. So the fact that it doesn't is very interesting.
Yeah. So is Bitcoin normally in contango then, as an asset?
Mm-hmm. It is normally in contango, and
because I think we're also seeing weird things in the gold market with gold and backwardation. So I wonder if it has anything to do with the the Fed rate decision that came out just recently, the negative interest rate policy that's there but may be changing. Do you think it has anything to do with these types of larger macro pictures?
It could. I mean, I think the gold markets in the front months have been in backwardation for a while, and it's really pretty concerning, because what it's saying is that, and I guess to take a step back, the gold markets are normally in contango because there's a significant cost of carry.
Right. They should never ever be in backwardation.
That's right.
It is a major canary in the coal mine.
Yeah, absolutely. I mean, with gold, you have to warehouse it, you have to store it. I mean, there's definitely some positive cost.
You have to insure it.
to insure it. Yeah,
The opportunity cost of interest that you might earn on the fiat instead.
Absolutely. So it makes sense that gold would be in contango. However, if it's in backwardation, it's suggesting something else, right? It's suggesting that, in the front months at least, it's suggesting that the spot market for physical gold right now is worth more than, paper gold in 3 days, right? But if you really think about it, that's
the opportunity cost. So it's better to have physical possession now than to have paper gold in the future, even with paying storage and insurance costs and giving up the interest rate that you would earn. So, I mean, it signals a major lack of trust in the overall system and delivery of physical.
Right, exactly. I mean, it's basically saying that paper gold has counterparty risk and significant enough to compensate for the cost of carry, which is very concerning because it's saying that the integrity of the capital markets is not, it's falling apart a little bit. It's not at its peak.
Falling apart a lot of it.
Yeah, it's falling apart a bit. So definitely very worrisome. Yeah, I mean, but going back to Bitcoin, why Bitcoin is in contango. I think there's actually a lot of different theories and ideas on it. I mean, in some ways, you could say that there is a cost of carry to the Bitcoin. In some ways, you could even argue that its natural interest rate is negative, and therefore it has to appreciate in price over time. Like there's a lot of different, arguments to be made, but this has generally been true since, even the ICBit days. The first forward and futures market for Bitcoin, it's always been in contango. I mean, the contango's come down a lot. I think back then, I mean, you could even see something like in 1 month, you could get 20%, doing a carry. I don't think that you can do that anymore. I mean, I think it's come down a lot, but it is still in contango. So it's still suggesting something or other based on whatever your interpretation is. I mean, it's hard to say, right?
Yeah, I mean, this is just very strange that, with $10,000, like you said, there's an opportunity for $60 of profit one way and $13 of profit the other way, and there doesn't appear to be that big of a difference between either ways.
Yeah, and really, it is just very strange. I mean, I don't know how to explain it.
Well, do you think part of this just might be the lack of sophistication in the Bitcoin markets themselves? Because there do seem to be statistical arbitrage opportunities all the time. The inefficiency of the different bank accounts and the fundamental plumbing that goes on behind the scenes with the various exchanges and everything introduces a risk, and maybe this is just pricing all that in, or there's asymmetric knowledge. I mean, there could be a lot of different reasons for it, right?
Yeah, I think that definitely makes sense. I mean, like, in some ways, to do this whole thing through the Bitcoin side, it requires multiple steps, right? And you could take like a couple of steps. You could get dollars into Bitcoin on Bitfinex. You can get into the Bitcoin swaps market in Bitfinex, but you also have to have an account at BitMEX, right, to do the futures. So maybe there's not that many people who have both accounts, or moving money between those two exchanges is difficult. Maybe there's something there. Maybe it's just that the market isn't very deep. So, we're seeing like these small opportunities here to make a little bit of extra cash. But, if you took it to larger and larger sums, maybe it would be more difficult. So maybe that's all it is. That could be what it is.
Yeah. What do so we've talked a little bit about the technicals behind this stuff. What do you think about some of the fundamentals that have changed this week? We seem to have a very big news announcement. Do you have any comment on that?
Oh, are you talking about the CFTC decision that Bitcoin is a commodity?
Yeah, exactly. Like, how's that play into all of this?
Well, I think they listed out some names, and I think the CFTC is saying that Bitcoin is a commodity, and they want to regulate all Bitcoin derivatives, including swaps, options, futures, forwards, that sort of thing. They listed out a whole bunch of companies that they think fall under their jurisdiction, and as I understand, they sent out some people from their enforcement arm to go talk with these players in the Bitcoin space. So I mean, I think it's very common to have this sort of thing where The IRS is saying Bitcoin is property. FinCEN is saying Bitcoin is virtual currency. Now the CFTC says it's a commodity. So, I mean, everybody wants, some regulatory oversight over Bitcoin. And it's really because Bitcoin sort of falls into, its own real category, right? I mean, it's such a new and nascent thing. In the beginning with the internet, it was regulated by, telecommunications, right? It was regulated by like the FCC or something like that. And correct me if I'm wrong, but I think it was like that. And it was only over time that we really understood that the internet was just completely something different. So I think Bitcoin is sort of in the same boat, and we'll see how the government, the government, different government organizations right now are sort of disagreeing with each other on what Bitcoin is. But in the end, they have to classify it, right? First of all, they either have to classify it as something that is different from everything else, or just say that it's either, currency, or it's either, a commodity, but not both, so.
Yeah, and I think it just highlights the importance of the regulators to want to work with the companies in the industry. For example, I was at the Consensus conference that CoinDesk put on in New York City, and Assistant U.S. Attorney Catherine Hahn, who leads the Digital Currency Task Force, she reiterated, I think 2 or 3 times during her presentation, just the importance of working with industry. And so did the people from the FBI and some of the other law enforcement. And so, it's very interesting when FinCEN or the CFTC comes out with, guidance or some type of a ruling, but where they don't actually follow the due process of law with like the rulemaking process, for example. And so they kind of, they need to work with industry, and they do carry kind of a big blunt stick, but at the same time there is this concept of due process of law and rulemaking authority. And so if they come up with all this guidance that they keep issuing and keep going down one particular path, and then that were to actually get challenged, and we've already seen from the mid-'90s that cryptography has been upheld as freedom of speech under the First Amendment. And we already have political speech and religious speech that's in the blockchain. So it'd be very interesting to see how all this plays out, and just, reiterates the importance that I think Ms. Hahn wanted to reinforce to everybody, that, look, everybody kind of needs to work together in order for us to move this forward. And otherwise it could really kind of get into a morass. And the last thing I think the regulators and everybody need is a long, protracted legal battle that strikes at the very constitutional heart of a lot of the issues, because that could take years, maybe even decades to resolve, in which time the technology would just, fundamentally run out from underneath them, go to other jurisdictions like the Isle of Man or a lot of this stuff. So it's very interesting to see all of this playing out. And maybe that's what these interest rates and covered interest rate parity and the differences in the swaps is kind of saying, is like, we need to understand where the underlying settlement assets are, whether they're USD or whatever, and what jurisdictions they're in. And then it's beginning to price that in.
Mm-hmm. Yeah, I completely agree with you. And, I think, more on the regulators, I think, with them, they have some good reasons for wanting to, know if Bitcoin is being used for money laundering or this and that, terrorist financing or whatnot. And I think it's only by working together with the Bitcoin companies that, we'll be able to help them out with that. And, if things get, really into a long protracted battle, maybe even going up to the Supreme Court on what Bitcoin actually is and how it should be regulated. I mean, that really helps no one, right? Like, it doesn't help the Bitcoin companies, because then they have to move to, other jurisdictions like the Isle of Man. It doesn't help the regulators because they lose their grasp on, being able to have oversight over Bitcoin. So I think finding some type of good compromise, which they don't stifle innovation, with too much excessive regulation. But at the same time, that the Bitcoin companies help them out, make them look good in front of all the other government organizations, and hopefully get them a bigger budget or whatnot. I mean, however, whatever their incentives are as a regulatory body, I guess beyond helping people and customers and consumers or whatnot, then we, I think the industry can definitely help them with that.
Yeah, well, and that's assuming that there's even an industry there. Looking at it, from my perspective, I mean, it was my money that has hired the chief compliance officers at BitPay and at Kraken, for example. And there needs to be a return on investment. And if there's not, then, we need to fold up shop and go somewhere else where we can. And the Isle of Man, they are rolling out the red carpet for this industry. So, I think it's important for the regulators to kind of understand that, the U.S. has no God-given right to venture capital. They have no God-given right to having industry develop here. And we've already seen the major Bitcoin exchanges are outside of the U.S. And it's only a matter of time, I think, before compliance costs get too high that they'll drive even more and more business outside of the U.S. unless they take a reasonable approach in working with a lot of the Bitcoin companies, because they. At least like Kraken and BitPay, for example, like we have AML plans, we have chief compliance officers, we actually implement those plans. We've helped identify people that law enforcement have asked for. So, I mean, those are the rules of the game, and we understand that. But if the rules cause the cost to be too high, then it doesn't justify the deployment of capital to that area. And, just like, I'm not going to invest in a company in North Korea, for example, there's no ROI on that. I'm not going to invest in a company in a lot of these jurisdictions where there's too much uncertainty, where the ROI doesn't justify the internal rate of return that's required for the project. So, it's going to be kind of interesting because the CFTC, they send this out and they're like, hey, look, we got another place where it's going to potentially cost you money.
Right. Everybody takes their toll. Isn't that right? Huh?
Yeah. But when you're dealing with startups, when you're dealing with a new industry like this, there just isn't the capital there. And, the big banks, you take the combined market cap and they still pale in comparison to the size of the tech companies. And we're seeing rumblings out of China right now that the way they want to grow their economy is through, tech and innovation. So, it's not that the big banks should be worried about Silicon Valley coming like Jamie Dimon is. He should be worried about Shanghai coming. And you know what? Singapore, they're rolling out the red carpet for the Bitcoin industry also. And Hong Kong's been very, very easy to deal with. So it's maybe it's just part of the shift of dominance from the west to the east. It's going to be interesting to watch it all play out, though.
Yeah, I hope that's not the case. I actually quite like it here in America. But, I completely agree with you. I think, where there is, sometimes there's, interest rate arbitrage, sometimes there's regulatory arbitrage. And that's just the nature of, how business goes. And if we, end up pushing away all these Bitcoin companies, this hub of innovation away from the States, I mean, that's a huge loss. I mean, can you just imagine if the internet was first coming about and there were, all the internet companies had to get an information transfer license, and then, search was considered a derivative on information and they'd have to get approval by some like derivatives organization and, and whatnot. Everything just gets mired up in that. I mean, Silicon Valley would have never developed,
Yeah. And I think one of the, they actually floated as a potential bill in Congress that in order to send or receive an email, you would have to go down to the local post office to do it.
Yeah, I mean, that's the whole thing defeats the point, right? I mean, the whole thing is so absurd, it really defeats the point, right?
Yeah, same with fax machines. So, if you want to live in like 1950s technology like North Korea currently has, and there's no reason that North Korea shouldn't be like South Korea and have some of the fastest, cheapest internet in the world. But it's solely because of the regulatory process in North Korea that they're so stifled. And it's interesting when you look at the cost of broadband, you look at the cost of internet and the speeds and everything, and the speeds of wireless. The U.S. is falling further and further and further behind. The Isle of Man, for example, in Q1 of 2016, they're going to be testing 5G, which is going to have 1 gigabit per second to your mobile phone for data.
Oh, wow. That's a good place to be. I like speed. Yeah.
Yeah, I mean, you got to have speed, because if you're going to be doing bioinformatics or genomics, you're moving around these massive data sets. You got to be able to move them fast. But I mean, imagine what type of apps and everything are going to get developed with 1 gigabit per second to cell phones. I mean, and yet, the U.S. is just going to be lagging behind. They're going to be using their typewriters still.
Mm-hmm. Right. Maybe devolve into using smoke signals or something.
Well, and I think there was actually even a joke. Like, one of the FinCEN people said, this was behind closed doors, but they said, even if you're transferring value with smoke signals, we claim the authority to regulate it. And so, I mean, if you want to take that large and expansive of a way of regulating, like, sure, but realize the industry is just not going to be here. And they're going to go somewhere else. And I mean, this process of de-dollarization is already picking up massive steam. The actual percentage of central bank assets that are held in dollars are already down over 10% over the last 5 to 10 years. And that process is speeding up. Russia, China, the oil producers, they want to increase the rate of that de-dollarization. I mean, everybody's kind of, chomping at the bit. And so, it's not something that should be taken for granted. This huge amount of capital, human capital that's come to the U.S., economic capital that's come to the U.S., maybe, we kind of have taken it for granted, and everybody in the U.S. thinks that there's just this God-given right for it. But now you have places like Brazil and Santiago where they're actively courting startups. Russia just rolled out a program that went live at the end of 2014 where people with startups can get permanent residencies and citizenship within 3 years. So they're importing human capital. I mean, everybody's wanting to import human capital. And human capital is very, very easy to just get on a plane and leave. And then, yikes, what do you do when you don't have the smartest people in the room anymore?
Yeah, it gets difficult. I mean, I think even Chile is they're subsidizing people to come and build startups in their country. And I mean, this whole thing is very worrisome, in my opinion. I mean, you really look at it. In history, the reserve currency of the world, I mean, usually has a lifespan of 70 to 120 years, and we're sort of well in that range for the U.S. dollar. So, I think we need to be careful that that we do things right so that we don't calcify as a country. And
how's a good way to kind of hedge that? Is it move into shorter and shorter duration term securities, kind of like the Chinese have done? They've massively brought down the duration of their treasuries, for example. I mean, they still own 4 trillion of them, so of course they don't want them to go poof overnight. But I think they sold 90 billion last month and 80 billion the month before. So is it just like reducing the duration and then kind of slowly moving out of any of your dollar assets if you can?
I don't want to make any recommendations, but I mean, it doesn't sound like a bad idea,
Well, I mean, is that how it would get played, like as a trader?
Sure. I mean, I'm of that opinion. I'm sure people disagree with me. I'm sure there are people who definitely like the back months on the treasuries. But I mean, I think, I would go shorter term. I wouldn't even go shorter term. I mean, I just really get out of it altogether. I mean, honestly, I think they just wasn't it just 2 days ago that the Federal Reserve said that there was going to be no rate hike, and the market actually went down instead of up, which is a bit peculiar. I mean, why would looser monetary policy cause the market to go down? So I don't know. I mean, there's a lot of ideas out there why that's the case.
Yeah, it might have to do with foreign earnings. Anyways, I think we've had a good chat for the weekly news and technicals. Thanks so much for being with us and letting us know a little bit about this covered interest rate parity and how that's affecting our Bitcoin price. We've had with us Kevin Zhou, former chief economist at Buttercoin. Thanks for being with us, Kevin.
Yeah, thanks, Trace. Always a pleasure.
Be sure to get a copy of the free Bitcoin Guide at freebitcoinguide.com. Got a question or suggestion? Record your voice at bitcoin.kn. Don't be shy. To help the show, share Bitcoin.kn with friends, post about it on Reddit, and otherwise spam the interwebs. Your iTunes comments and 5-star reviews are very important to us. Please continue tuning in to the Bitcoin Knowledge Podcast, where we release interviews with the top people in the Bitcoin world. Now take some choline and let that Bitcoin knowledge consolidate.